After decades of building a successful middle market business, you deserve to have a successful exit, one that maximizes value, protects your people, and preserves your legacy. My name is Brad Scharfenberg with PCE Investment Bankers, and today I'll walk you through the 3 core exit strategies and how to choose the one that aligns with your goals. Whether you're considering a strategic buyer, a financial buyer, or an ESOP, understanding the distinct benefits and trade-offs of each will allow you to make an informed decision and exit the business on your terms. First, it's important to understand that this isn't just about cashing out. A well-crafted exit strategy determines how your wealth is preserved, and it safeguards the legacy you've built. So before you compare exit options, you need to clarify your objectives. Are you willing to stay involved, or do you want to step away immediately? Do you want full liquidity now, or are you okay with a gradual payout after closing? Is preserving your company's culture and brand important to you? Your answers will guide you toward an exit strategy that aligns with your personal goals and vision for your business. Now, let's explore the 3 most viable exit options and their pros and cons. A strategic buyer is typically a company operating within your same industry. This can be a competitor, a supplier, or even a customer. They're interested in acquiring your company to capture synergies and expand market share. With a strategic buyer, you typically get 100% of the proceeds at closing, and you're able to exit quickly without further involvement. They may pay a premium to acquire your business, especially if synergies and cost savings are significant. However, your company culture is at risk. The buyer will likely implement their own systems, processes, and branding. Confidential information and trade secrets could also be exposed to competitors. This option is strongest when your business is highly complementary to another industry participant, when significant synergies exist, or when you're seeking an immediate exit with maximum liquidity. Next, let's discuss financial buyers, such as private equity firms or family offices. These investors are more focused on return on investment rather than operational synergies. They may acquire a controlling interest or a minority interest depending on their investment objectives. Financial buyers bring capital, expertise, and ambition for growth, while you maintain operational control, at least initially. The return on rolled over equity can be significant. We call that a second bite at the apple. On the downside, since synergies don't exist, financial buyers might offer a lower price than a strategic buyer might be willing to pay. They often use leverage and focus on maximizing short-term profits, potentially at the cost of long-term value creation. Choosing a financial buyer is ideal when you have a strong management team in place, sustainable growth plans, and an appetite for a growth-oriented partnership rather than requiring an immediate exit. The third exit option is an employee stock ownership plan, or ESOP, which involves a trust purchasing the stock of your company to provide a beneficial ownership interest among your employees. You can sell partial or full ownership interest to an ESOP trust using bank or seller financing. This exit strategy offers the strongest protection of your brand and legacy, while incentivizing your employees to succeed. There are also tax advantages for you and your company. An important trade-off is that you will not receive any premium for synergies that a strategic buyer might pay, and you only receive 30 to 50% of proceeds in cash at closing, with the remainder paid over a 5 to 7 year period. This approach is the best option for preserving your company's culture and is ideal for owners looking to retire in the next 3 to 5 years who are comfortable with a gradual payout. Now that you have a solid framework, choosing the right path means selecting an exit strategy that aligns with your goals and business realities. If you want full liquidity and believe a strategic buyer would pay up for synergies, that may be the best option. If you believe in the growth potential of your business, but want to take some chips off the table, pursue a financial buyer. If preserving your legacy is paramount and you want to empower your employees, an ESOP can be compelling. Sometimes making a decision isn't always straightforward. That's why we created a dual-track process at PCE, which allows you to simultaneously explore a sale to a strategic buyer, a financial buyer, while concurrently pursuing an ESOP transaction. This approach gives you the flexibility to compare the outcomes and benefits of each exit strategy in real time, leading to a more informed decision. If you're interested in learning more about the dual track process, click the link in the description. Your business deserves a strategy that maximizes its value and secures its legacy. Whether you're considering a strategic buyer, a financial buyer, ESOP, or a dual track process, PCE can help you prepare for a successful exit and guide you through every step of the process. Thanks for watching. For more insights on exit planning, subscribe to our channel and stay ahead with the latest advice from our team of experts.